The energy markets are the lifeblood of our economies, yet they remain unpredictable, shaped by delicate interplays of geopolitics, political policies, and market demands. Each day's news carries implications that ripple outward, often setting the stage for profound shifts. It's not just about pricing and production, it's about adapting to an evolving world with all of its challenges and opportunities. I'm Mark Roach, and this is Future Wise Energy. Today, let's explore four pivotal developments reshaping potentially the energy scene and examine what they mean for those of us navigating this complex industry. Certainly, the crude markets are offering a lot to unpack. West Texas Intermediate stands just a little while ago when I checked it at 68.17 a barrel today, marking its highest level in over 2 months after a recent 4% surge. This uptick isn't occurring in isolation. It reflects the weight of escalating tensions between the US and Iran. Similarly, natural gas is showing remarkable volatility. Henry Hub natural gas shot up nearly 17% in just a day, with prices at $3.52 per MMBTU. For energy professionals, these moves are more than just numbers, they're signals, symptoms of a world that remains fundamentally unpredictable. What's driving this? Well, the heightened geopolitical tensions play a major role. Concerns over Middle East supply disruptions are adding a premium to oil prices, while rising demand for natural gas is amplifying market movements. Yet the burning question remains, is this a temporary spike? Are we on the brink of a sustained change? Well, the answer doesn't rest solely with market data. It's intertwined with policy decisions, global reactions, and economic shifts, each vying for attention in an increasingly fragmented narrative. Shifting focus to policy, few actions recently have been as consequential as the Trump administration's move to block California's electric vehicle sales mandate for 2035. This decision reverses the state's authority to enforce stricter emission standards and directly impacts the regulatory trajectory of 17 other states aligned with California. For the oil and gas industry, this represents at least a significant temporary victory. Removing mandates like these staves off what many in the industry see as an existential threat to gasoline and diesel demand. From the upstream perspective, this alleviates a major regulatory headwind, at least for now. It's a pivotal moment celebrated by industry entrenched players who view it as a reprieve from the growing pressures of rapid EV adoption. However, this more than meets the eye. The challenges tied to energy transition won't simply disappear. States like California are expected to fight back, whether through legal avenues or alternative regulations. Environmental and public health advocates are also mobilizing, creating a stew of opposing forces that ensures the story is far from over. Energy professionals know this well. It's not just about applauding relief today, but anticipating resistance tomorrow. The key lies in maintaining vigilance, both for what the decision enables in the short term and how it defines longer term shifts in the energy landscape. Meanwhile, alongside domestic policy shifts, global dynamics keep energy markets in flux. Consider the unfolding narrative between the US, Israel, and Iran. Iran continues to expand its nuclear ambitions in defiance of mounting international pressures. Diplomatic solutions remain elusive, and Israel appears increasingly willing to act unilaterally should they fail, should the talks fail. The stakes are immense. For energy markets, any military action involving Iran carries significant implications, particularly for the Strait of Hormuz, which serves as a key transit route for nearly 20% of global oil supply. A disruption here would send crude prices soaring, potentially exceeding $100 a barrel. Yet on the flip side, a diplomatic breakthrough, one resulting in a US-Iran deal, could flood the market with Iranian oil, causing prices to plummet by $5 to $10 a barrel, at least for a while. These contrasting scenarios reveal the high-stakes volatility in today's energy environment. Producers and traders alike are preparing for either extreme. Risk premiums can be seen across the markets alongside heightened caution and strategic hedging. Still, we're left with one undeniable truth. Very few outcomes in this scenario offer stability. The only constant is the need to adapt in real time while the forces shaping global energy markets remain outside any single player's control. Overlaying all this is a fascinating balancing act by the Trump administration. There's a clear objective to keep prices within that $60 to $65 barrel range. And the logic is sound. Low oil prices curtail inflation, enhance consumer spending, and create favorable conditions for economic stability. Yet this approach also reveals a tension within the administration's broader goals. Keeping prices low undermines domestic oil production, especially at a time when smaller operators are already facing razor-thin margins. Compounding this policy are tools like tariffs on imported materials and sanctions on major oil producers, all of which exert upward pressure on costs. Layer in geopolitical risk from escalating tensions in the Middle East to the troubled Strait of Hormuz, and it's clear this is a plan walking on a razor-thin edge. The paradox is inescapable. On one hand, aggressive deregulation and production incentives aim to stabilize prices and stimulate growth. On the other, external shocks, from sanctions to regional instability, increase volatility and push those ambitions further from reach. It's a vivid display on how tightly interconnected global systems have become and how unpredictable outcomes can reshape even the best laid strategies. And so we find ourselves here in a moment characterized not by certainty, but by flux. The tectonic plates beneath energy markets are shifting as deeply as these geopolitical and social landscapes. But rather than pushing forward as we once might have, the smartest voices amid the turmoil may just be calling for something different, not rash action, but patience, restraint, even a willingness to yield temporarily to forces that feel larger than life. Patience, not action, may very well define resilience in moments like these. The shifting foundations of our industry demand clarity, the kind that allows us to see true scale of what's happening before we leap forward. Complacency is not our enemy here. It's the wisdom to understand that sometimes the strongest choices involve waiting and recalibrating. Kind of reminds me when the smartest guys in the room were all wrong. This certainly makes for dramatic headlines. U.S. upstream oil and gas has survived chaos such as this before. The appeal of our Constitution, our thirst for freedom, and the relentless drive and aspiration of the American dream and the American consumer to sustain our lifestyle seem to have won out time and time again in my lifetime. We like to believe in the industry that we thrive on resilience, not rigidity in the oil business, but in actuality, it may very well be the adaptation, along with our use of science and technology, in spite of the chaos that continues to drive our and my own repeated return to oil. Adapting to change requires equal parts boldness and understanding that there's strength in stepping back to gain perspective. At FutureWise Energy, I must encourage and even dare to use the word champion this kind of balance. Success defined by dignity comes from transparency, adaptability, and a relentless focus on staying ahead of the tremors and the chaos. I'm Mark Roach. Here, find myself wishing FutureWise had that crystal ball, but I just don't see it in times like these. Wishing you all the best.